Hey everybody, Signet here with the OEC. So to kind of go along with the big account theme, I kind of wanted to fill you guys in on a trade I've been working on. So this is New Residential Inventory Corporation. That's a big name, isn't it? It's a high dividend stock, and it's a fairly cheap stock. I'm still growing these different accounts out. So I focused on this one because of its dividend history. It's got a pretty decent chart history as well. This thing pays a dividend of 25 cents per share. And the idea here was to pick up 100 shares and kind of maybe sell some calls against it while also collecting the dividend, right? Let me point out what I'm looking at here. It's got a yield of 9.65%. It has a 25-cent dividend, and the dividend is paid quarterly, so 4 times a year. The stock price right now is about $10.36. This dividend per share for 100 shares will pay $25 per share every quarter, and there are 4 quarters in a year, so this will pay $100 every year in a dividend. Now that's not bad as long as it doesn't lose all of its stock value, right? Because if it does that, then we're going to be in the hole. So that's one thing that it can do. It's just making dividend, right? And we don't get something like this thinking, oh yeah, that's a nice short duration trade. I'll get in, I'll get back out, be nimble with it. It's more like you look around right now and Google, Facebook, Microsoft, all the FANGs, the indexes, the stock, everything's down, right? Everything is down, or it's running just parabolic to the moon. It's violent, volatile. I wanted something that was not doing that, something that's been maintaining itself throughout all of this chaos, maybe something not really tech related. It's got a little bit of a slower beta. It's really not moving around all that much, and this fits the bill. Residential, right? And it's got a really good dividend. It's cheap. So let's go out and look at the stock for a moment. Okay, this is a 5-year chart, and okay, COVID was not very friendly to this thing. Okay, things were doing okay, slightly moving, to the downside. It wasn't phenomenal, but it was maintaining above that $14 range year after year after year, and then COVID hit. So that took us to the downside hard and fast. It kind of rebalanced itself a little bit, came up to that $10 mark by the end of the year, and it's been holding steady underneath the $12 mark. But it's also been holding itself relatively well above that $8 mark, right? Now, there's no guarantees in life, but this is a decent company. It's got a decent return. It's got a nice dividend to it. Well, let's look at it a little bit more. What else could we say about this company, right, or this stock? I want to maybe do a little bit of earnings analysis. So we come in and maybe we look at the earnings on this. So hate it when it does that. If we look at the dividends and we look at the earnings, we're on a 2-year daily chart. And then the last 2 years, we came back out of that COVID debacle, been maintaining really nice below that 9.5. or above that 9.5. But look at the big down day moves. And what this is, this big down 8-day moves, it's saying 8 days after earnings, how many times in the last 2 years has it made a move bigger than 5% to the downside? Only once. How about big down days less than 5%, between 0 and 5% on an earnings in the last 2 years? 3 times. So that's 4 out of 8 earnings where things went to the downside, and it was at least a 5% move or less, or a 5% move or better, and yet it's still holding these levels, right? So if you think about, like, how'd Netflix do after earnings? Oh, not too good. What about Facebook? How'd Facebook do after earnings? Yeah, no, not too good. On the up moves, 8 days after earnings, did this thing make really big moves to the upside? Less than 5%. 4. So of the 8, 4 of them made downside moves, 4 of them made upside moves. None of the upside moves were ever bigger than 5%. What's this telling us? Well, it's missed earnings 4 times. It beat earnings 4 times, so it's been half and half. It's still maintained through all of that, right? Now, there's a lot of clutter on the chart right now. I mean, there's just so much information here. We really want to see the earnings. I brought this up so that we could see, like, some of its history, but now I'm going to take all that off. And what we want to focus on is, what's the dividend been like? Well, the dividend was 10 cents because we were still coming out of COVID, and then it went to 20 cents, so they doubled that dividend, and it held at 20 cents, and then it held at 20 cents, and then they increased it to 25 cents, and they increased it again another 25, or not increased it, but maintained it 25 cents again. Now, I'm watching the news on this thing because what I don't want to see is that they downgrade that dividend. That's really going to make this stock go down. In my own personal opinion, that would drive us to the downside. I don't want to be in it for that. A lot of companies canceled their dividend, or just flat out, stopped the dividend altogether during COVID, but they all started to bring them back as soon as they started to recover out of the COVID drop. And as long as this maintains a fairly reasonable dividend, I don't expect it to drop. A lot of people are in this strictly because of its dividend, and if they drop the dividend, I think a lot of people will drop the stock, right? So I'm not worried about the stock because of the company or anything like that. I'm only going to be worried about this stock if any news comes out about their dividend, right? So you want to watch that. May 3rd is where they're very likely going to say something about that dividend, so we want to be watching the news on this. And you see how I brought that news up? I just hit the button. Okay, I don't have to have a special news service. I don't have to go pay for news of this sort. It will land in here. We may not be the fastest to know about it when you have free news, right? But we would know about it. And the idea is, I own the stock, right? I got 100 shares, and I'm looking at selling a call in here. Now, we don't want to sell a call like the farthest out, because, like I said, if the stock was to go down, say like a COVID-related situation, they're going to drop the dividend again. And I think if they drop it too far, people will just abandon the stock. And also, they could get in a bind just like any other company and lower that dividend on their own. And that, I think, would cause investors to drop the stock. So we don't want to go too far out. I was looking at the Januaries, but we want to just take a look around, right? There's no special number, no special strike that we could look at and say, oh, this one's so much better than the others. But let's just open them all up and take a look around and kind of have that discussion about, well, which one of these should I sell? right? And if I sold it, what would the consequences be? So I kind of like the 56 days out. If I sell this one, then I would get the mark or the mid price. So here is the mark, and the mid price would be on that 10-cent strike or the $10 strike. It would be around 75 cents. Now I paid around $10 for this stock. I'd have to check my Fidelity account to see exactly how much I paid, but it was somewhere in the $10 area. So if I collect $75 on this for the $10 strike and the stock happens to go just bonkers to the upside, my $10 call is going to go uh, in the wrong direction, right? We need stock to stay below the strike we sell. But I'm not going to be too worried about that because you know what? The worst that would happen is that I would lose my stock at $10 a share, but I would get to keep the uh, the premium from this sale. So I would get $10 a share, and then I would get 75 cents or $75 from the sell of this call, and I'd be okay. But that's if I held it all the way to expiration and if it rallied really far, putting this $10 strike deep in the money. And I don't expect it to rally really far, but I don't expect it to fall either, right? Let's go back out and look at the chart. Now remember, a lot of this analysis on a daily chart in the current environment with everything being as wacky as it is, you know, we could do a lot of things. We got the Fed announcement coming up. This thing's got earnings coming up. I mean, there's just all kinds of things that could move us around. So I'm not too worried about it going up to $12. And I'm not really worried about it going down to, say, around $9. If I sell that call, I already know I could just not defend it at all, sell it for $10, and if worse comes to worse, give away my stock at $10 a share, keeping my credit and unloading the stock at that price. But I don't think it's going to come to that. Instead, what I think is we'll sell that call and it will decay in value some between now and earnings, and I'll buy it back before we get to earnings from that decay, and then I'll sell it again. Or rather than buying it back and selling it again later, I'll sell that call, and before earnings, I'll roll that call farther out and just keep the trade going. And that would buy me more time. Now, because of earnings, I want to be kind of nimble. I want to try to bounce on the other side of earnings. But once we get past earnings, we'll be looking at, say, the June series. And while it's 56 days out right now, when it gets to be around 30 days or 18 days, maybe even 12 days to expiration, I'll be wanting to come in and day trade these on a short side, right? The idea would be, say, that I would go in and look at it on an intraday basis and find opportunities to sell the call and maybe buy it back near the end of the day, right? Look for another opportunity to sell it again and buy it back near the end of the day. And if you do that when you're closer to expiration, its day-to-day values will change quite a bit, and we'll be able to really uh, collect a lot of premium. Now, it's hard to try to keep track of such a thing, right? I don't go in there and really kind of scratch my head too much and say, "Oh, I forgot my average stock price. What was it? I got to recalculate it and get it all figured out," because I'm only running 100 shares and it's a very cheap company. But if you were doing this on a bigger company and you were in and out a lot and had a lot going on, you would definitely want to record all your values, right? But if I sell this for $75 and I buy it back at like $40, then I made $35 profit, right? And I could take that $35 and subtract it from my overall stock value that I'm holding right now, and that would reduce my average share price. And the next time I sell it, maybe I would give it a little more time or a little less time, like I was just discussing, and I could be more nimble about it, kind of getting in and out of the market. And the idea would be I want to eventually get my average share price to be around $8 or $9 a share. It's going to take a little bit of time, but this is what, when I tell people I work for a living trading, this is work. This is what I'm talking about. It's not the idea that I want to go on the hunt all day, every day, trying to find something with big momentum and strong trend on an intraday basis. And that is folly, right? If we're not having a good day, it's just a sideways market. If SPY's not doing anything and we're just a day like this, there's nothing out there I want to trade on a day like this. I'm not going to find high momentum and high trend. And even if I did, it will probably be in something I wouldn't want to day trade. But when I'm already owning something and I can go in and sell against that thing that I own, my ask out of the market is so much cheaper, so much easier, right? Suppose we were talking about SPY instead of NRZ, and I would be going in here and maybe, selling a call there, buying it back down here. And of course, I'm looking back. The day is done. The candles are easy to see. But this would be what I would be looking for, right? Those opportunities are so much easier to spot and identify and defend against. If I sold that call up here, say the next time we came up and I sold the call and it ran through me and kept going to the upside, well, that's so much easier to defend than trying to buy a put there, right? If we bought a put and it went against us, that'd be much harder to deal with. So it gives me a chance to be nimble. I can go in and trade multiple products. This one that we're discussing, it's great for a learning curve. This is a good stock to bring to you guys as an example. It's a live trade. It's real. We're talking about it on Thinkorswim, but I have this in my Fidelity account, and I don't think Fidelity has paper. I could be wrong. Fidelity might have a paper account, but I certainly don't use it. When I'm on a paper account, I tell everybody it's paper. I log in on paper so you can see that it's paper. And I don't think that most of the time trying to teach on paper does any good. Now, I have done it. I've made videos on paper and shown, there was a reason. Just the other day, I logged in on a paper account because I deliberately wanted to put on a losing trade and demonstrate how the options values changed in that losing trade. Well, of course I'm going to go to paper to do that. I don't want to put on a live real trade deliberately trying to lose just to show you something. I would go to a paper account and do that, right? That way it can lose and nobody cares. So this is the kind of stuff you want to be thinking about. This is the kind of stuff you want to be looking for, right? What out there right now would you perhaps be willing to own? And once you own it, what could you do with it, right? Like, what would be your intentions? Okay, you got this thing. What are you going to do with it? Can you reduce your risk? Can you, can you size up with it and do anything, So here you can see I'm going to be getting out of this one, and that's why we're talking today. I've already got a call that I'm short in, but that's not the point, right? I'm going to be getting rid of this one soon, and we're to be getting into another one. But yeah, I mean that's the trade right there. NRZ, my average share price is 1036, down because the stock went down today, right? And yet it's not a big deal. I've got $45 in credit, so I'm going to slowly whittle my average share price down in this thing. And the idea is I want to get it get my average share price down below that $8 or $9 level, with the idea, if we come in here and look, if I'm selling a $9 option, let's get a little closer to the money so you'll kind of understand it better. If I'm selling a $9 option for $140, $145, if I happen to lose that stock at $9 a share, I'm still losing it at $9 a share plus that $1.45 that I had, right? That, if you add that up, that's 9, 10, 45, 10.45. Well, if this isn't the first time that I sold that call, if I've been selling calls on it for a while and my average share price is that $8, now I've got a total of 10 something just for this one strike. And then I had all the other profit that I made from the other calls that I had sold, right? So you see how we want to put these things together. Now, look, if you did this on something that was more expensive, that had weekly options and a high options volume value, you could do much better than this, right? But I'm working in a smaller account. That Fidelity account is, it's really new, it's small. We call this the 20-year savings plan. Me and my wife put this together, say, about 18 months ago, I believe. It'll tell us down here. I believe it was August of 2020 when we put that together. And we started with $500. And we've just been growing it out since then. And, you know, it's not doing too bad. This is the first options trade that I've been doing in this account. All the other trades have been nothing but stock. And here's that account balance, right? It's just one of the accounts. I like to diversify. I have a lot of different brokers, a lot of portfolios, a lot of accounts. And then I use those different accounts differently and do different things with them. But with this one, right, we started out, we got to go to the 2-year date. We started out with that $500 on August 28 in 2020, and it's just been, you know, a slog. You can see we went sideways for quite a while because between, you know, say October and January, things were a little rough news-wise, and I got out of a lot of things, and I said, well, if we break to new highs, then I'll get back in. And we did that, so I got back in, and it wasn't very long after that that I diversified, or that I liquidated the entire portfolio and said, nope, that's it, we're getting out of everything. It was right around January, right? So if you look at what's been going on in SPY, when I liquidated, it was back here. I got out of everything right around in there. Let's kind of look at where that was. September 8th, basically when I liquidated everything. Well, there is September 8th right there, that blue day. That's the day that we got out. I liquidated the whole portfolio on that blue day, that little doji day. Goodness, it just isn't doing what I wanted it to do. So that little doji day is where I got out of everything, and I said, all right, well, if we rally back up and get past that, then I'll get back in again. And we dojied, or not dojied, but we got a Busby there. That was my re-entry, and ran it back up. We got close to the end of the year, and things just were looking really bad. I said, you know what, that's it. I'm getting back out of all this stuff. I don't care. And well, I mean, you know, it's a good thing I did, right? Got back out of everything. Where was my last exit? Got into the new year, January 18. Yeah, we were flat by then. So we were right into the new year, November, December, January. And then since then, all that flat area right there, there was a little bit of a run. We can zoom in now. So there was a little bit of a run. that was me rebuilding the portfolio a little bit. And then the downwardness here is where I started liquidating everything. I said, I don't care, I'm just getting out. And when we started to really drop down there in later part of January, I started buying mutual funds, right? So here in the later part of January, that's when I started buying mutual funds. And I've been slowly buying into those mutual funds. And I still am. You know, it's there's no rush, right? Just I've been kind of cost averaging in a little bit at a time. I buy some more, I buy a little bit more. So we got like the small caps, the sustainability index, large caps. Of course, I got ARC getting just murdered in that thing. But yeah, just kind of hanging on, slowly putting this back to work again. When it comes to owning things like mutual funds or even the indexes themselves, I don't think this account's really built yet to be buying SPY or the Qs, but we buy these mutual funds and it's very similar to those. But while those aren't doing too good and I'm just slowly allocating in, I wanted to do something else with this thing. So that's where these NRZs come in. I thought, well, let's just go ahead and start putting some of this money to work in maybe a good dividend stock. And so I picked this out of the things that I was looking at. This looks pretty good. What I'm really impressed with, if you kind of look at or think about what's going on out there with all the chaos and the madness, everything dropping like crazy and just losing its value really hard, this thing is just trucking along. You know, it's just maintaining that range, and that's what I needed to do for a dividend stock, right? I wouldn't mind getting a little more speculative with it, maybe, you know, putting on some kind of verticals, but it's not designed for that. And I'm not even wanting to approach it that way. I'm not looking to increase risk here, right? We're talking about allocating some real funds into something and knowing that we can defend it. Well, with this, I don't really need to, right? I could size up in this. I don't have to have 100 shares. I could size up in this and to sell more than one call. It's keeping track of where my cost basis is and recognizing that if I sold the call and it ran me over, that I would be getting rid of the stock at a higher value than I bought it, and that is a win. The only thing that is real risk here is if it dumps during another COVID style event or if they cut their dividend, because I really think if they cut that dividend, it's going to really take a shot to the downside, right? So that would be really the only two things of concern. In fact, you can see when they were running 20 or from 15 to 20, it had a nice little bump, right? And then it got to 20 and it stayed at 20 and it stayed at 20 again and it kind of sold off a little bit. And when they went to 25, well, it popped right back, you know. Maybe it went to 25 and they started to sell off a little bit since then, it seems. Right, where's that first 25 dividend? Right there. So it kind of peaked after that, and it's been just, you know, maintaining it. That's the name of the game, right? It's just maintaining. So I want to see them maintain that dividend, and I want to see it kind of maintain above that $9 mark. Now, one thing you want to be thinking about with a stock like this, what's your ripcord, right? What's that point in the sand where you say, you know what, I don't care. I don't care about the dividend. I don't care about whatever. I'm just getting out. What would that number be? And for me, the number is 7. I think if it gets below $7, it's going to be very hard to try to sell options on it and try to get my money back. But I don't really think that I would actually let it get to $7. I think if we break that low that we currently have around $9, then I would start really going through the news and asking questions and saying why is it dropping below that $9 mark? You know, did they are they having issues with their credit? Did they get a new CEO? Like, you know what I mean? Like, I'd be digging into it and asking questions because it won't be some pattern on the chart that makes it go down. It'll be because of some fundamental reason. Their mismanagement of money, different CEO, maybe a failed project. You know what I mean? Like it would be something. So if we even started to threaten or tickle that $9 area, I would be diligently searching for news. And I've got paid news sources that I can go and look at. I would try to find out, hey, what's going on? But I got to tell you, I'm busy. I don't do that kind of work on a day-to-day basis. You certainly should or could, right? I'm not saying that you shouldn't. I'm busy. I've already done the diligence that I needed to do to be comfortable with the purchase to begin with. And I don't go in looking at every dip every day saying, oh, it went down a little bit. Let me go deep dive and find out why. And that's why I said, I won't really do that kind of work until it gets around $9. I'd be really uncomfortable seeing it get below 9 and still wanting to stay in it, right? Because there's other things we could do this kind of trade on. So, I think maybe this video went a little longer than I had intended, but I wanted to share this with you guys. Today is April 22nd, so, you got an idea of what I'm looking at. If you had not yet thought about getting into something like this, or you are thinking about getting into it, just keep in mind that there's an earnings coming up on May 2nd, I think, May 3rd. And at that earnings, they very likely could announce something with their dividend. So, you know, um, perhaps you would want to take a look around, make sure they're not going to do any kind of dividend announcement. Maybe go check their last dividend announcement and see if they mentioned anything about maintaining that dividend before you think about maybe getting into this, right? Or even let it report. I'm okay holding it because I've already got that call sold. Fine where I'm at. Things are okay. Um, but if you're not yet in it and you're thinking, yeah, maybe that don't sound too bad, then maybe check that dividend out first. Make sure that they haven't all, because most companies, they'll give that nudge, that forward guidance if there was something going on with the dividend. And the fact that it hasn't sold off significantly kind of just tells me already that investors aren't looking at this thinking, oh yeah, they said they're going to cut their dividend, because if they said something like that, I think we'd already seen it in the chart, right? So this is a good learning product. It takes a lot of practice and a lot of experience kind of just doing the thing. I call it windshield time. You got to have time behind the windshield. You got to drive that bus. And little things like this, even if you screw it up and it goes sideways on you, it's a small product to learn on. The lessons, while losing is painful, the lessons are small compared to something like, say, Amazon or Roku, or there's so much expensive stuff out there. This is cheap. It would be painful enough for you to learn a lesson, but not crippling enough to wipe you out. And there's a lot to be learned on just doing the thing, right? Going through the machinations, pushing the button, running the math, asking the questions, digging a little deeper, looking under the hood and seeing what this thing is and what it does and what its history is. That's what I got for you guys. Feel free to ask questions. I know the chat in the Discord is really kind of not there, but it can be. You got questions, you want to throw them in the chat, by all means. I'll do my best to answer them with the keyboard, and if I can't, well, we'll just talk about them in the next coaching session.